Okay, colleagues, please take your seat, and I think we are ready to start. Right. Okay, I think we can start. Thank you very much to all participants and people in the audience for being here with us. I'm going to say a few words about the EMU Lab, then Thorsten, something more specific on this session of the EMU Lab. Now, the EMU Lab was launched several months ago. Giancarlo Corsetti and myself, we are steering it. So Giancarlo, Pierre Berner Chair across Robert Schuman Center and the Economics Department, and myself as Tommaso Padova-Schioppo Chair at the Robert Schuman Center. The idea is indeed a lab, so trying to do our best to stir up a bit the debate and unlock the debate on economic and monetary union, which on many instances seem to be grounded somehow. So we are trying to take a bit of a novel approach, doing initiatives on several grounds. So the EMU Lab sessions like this one are the flagships of the laboratory. Then we have workshops. We have seminars, a series of seminars that we have launched, which have aroused quite a bit of interest. And the idea is to really optimize what we have at the European University Institute, which is a large set of skills, a multidimensional and multidisciplinary approach, not only because we have all this wealth of knowledge here, and also mobilizing all our networks, but also because the assessment is that if we do not take a broader multidisciplinary perspective, putting together the economists, the political scientists, the historians, but also policymakers, market participants, etc. If we don't take this comprehensive approach, it's very difficult to succeed in this endeavor. So this is the third lab session. We had the first one in January on, we took a broad historical perspective on European economic and monetary integration. Then we had about a month ago the second session on fiscal stabilization. The both went, I think, went very well. So this is the third, and then now we are throwing the ball then to after the summer, and we'll do something, I think, on focusing more on monetary policy. That's what I wanted to say at the outset. We count very much on a lively debate, as we always do in this case. And maybe Thorsten can add on the specific session of today.
Yes, well, thank you very much. So I'm Thorsten Beck. I have two functions at the EUI. I'm a professor of financial stability, but I'm also the director of the Florence School of Banking and Finance, which gives me the privilege to work with many young and very bright people. And given that the topic today is capital market unions, we decided to team up with Giancarlo and with Marco on this specific topic. Now, on capital market union, it's been a topic, of course, it has been around for 10 years or so. I think initially launched in 2014-15. Some initiatives have actually proceeded, most have not. We are certainly far away from the goal of having a large capital markets that can support European economies and societies. And the question today is, of course, what has gone wrong and what can we do about it? Now, of course, when you talk about capital market union, it's a little bit about similar to reforms of the banking union. You run the risk of sounding like a broken record. So record for those who are young enough, this used to be before we had CD-ROMs and apps for music. So we're trying to do a little bit of a novel approach, and one of the novelty is that, at least for me as an economist, one of the novelty is that we look beyond the kind of the economics little sandbox, and also talk about how can we actually get there, because economists always like to talk about what is needed and or what do we want and what is needed to get there. But how do we can actually politically implement it? That is typically not part of our brief, at least for most economists. So, and I think coming back to what Marco mentioned earlier, this kind of interdisciplinary character of the Robert Schuman Center, where we all are part of, Giancarlo, Marco, and I think is really is a good kind of basis to have these discussions. Now, let me also say that I mean, there are lots of panelists today. I'm not going to introduce them at this stage, I think, but two persons I want to introduce. The first one is Catherine Carlson, and we're very, very happy that she has joined us to moderate the two panels. Catherine Carlson is with Political Europe, but some of you who have been here longer than I actually might also remember her, as she has worked here at some point. And then the second person that I'm going to introduce in a moment is Marco Pagano, who will kind of kick us off with a short presentation, lecture, whatever you want to call it, on why do we actually need a capital market union. Then after this, we go into two panel discussions. The one is kind of what do we need and why haven't we gotten it yet, and what has gone wrong over the last 10 years in terms of the policy implementation of actually getting to the capital market union. Maybe also a little bit about the interaction with the banking union, complement differences, and so on. And then the second panel will be more about specifically how actually are we going to achieve that. And of course, it is a very timely moment to discuss about this, because we have elections next month. We have a new commission coming in, a new parliament, and maybe, just maybe, there might be a chance. I mean, we are allowed to, as academics, we are allowed to dream, right? And then, of course, we're going to have also the dinner speech later on by Thomas. Now, this, I think what I want to do as an introduction, I think I want to make one housekeeping remark that pops into my mind right now. Whenever you speak, please use the microphones, or the people on the screen, both the ones who are active in the discussion, but also the broader audience who can follow us, so they can hear you. Okay, so always please use the microphone. Good. Now, I guess without further ado, I would like to introduce Marco Pagano, professor at Federico II. Actually, I found out only recently that Federico II was a German emperor, and he actually comes from a family close to where I grew up in Swabia in Germany. Marco is, I would say, one of the most prominent and prolific financial economists in Europe, if not worldwide. But he's not just an academic. He is actually also one of my predecessors as the chair of the advisory scientific committee at the European Systemic Risk Board. And I'm mentioning this because in this, when he was at the advisory scientific board, committee, sorry, he also co-authored a report which then later made it into a paper about the bank bias in the European Union. And I would say this has been quite influential also in the policy debate in terms of underlining, emphasizing the need that we have to we have to look beyond banking towards a more diversified financial system, and that yes, capital markets have to play a very important role in this context in the European financial system. Now, this paper was written, I think, like 10 years ago, 10, 12 years, and I'm sure the argument has become even stronger, I would argue, but I leave it to you, Marco, to kind of guide us through these arguments. Thank you again for coming.
Okay, thank you very much. Thank you for inviting me here. Thanks, Thorsten, for the very nice introductory comments. The paper actually came out in 2016 in Economic Policy when you were the editor of the journal. What I will be talking about is not only why do we need a capital market union, but I also saw on the program that the subtitle of my talk is also state of play and the current gap. So also give some kind of an assessment of where we are and where maybe we should be going. So let me see if this works. This doesn't seem to work. Maybe I should switch it on, or yeah. Should I move over there?
No, just to click on the presentation. If you click on the presentation right now.
Okay, yeah. Okay, now it works. Thank you. Okay, so in terms of more or less what I'm going to say is I'll start from the really basic point of what we mean by a capital market union, why it was initially proposed in 2015, why it has not materialized so far, except for some elements maybe, why actually we today we need it more than we did at the time when it was initially proposed, and what we need to do in order to make it happen in terms of sequencing, timeline, what kind of pushback we are likely to meet in its implementation. Okay, one point that I would make towards the end is also a note about the banking union. This is often a forgotten issue, that the banking union is largely unfinished, and that in my view, we cannot hope actually to realize a capital market union without actually completing the banking union as well. And I will try to explain very quickly why that is the case. So just starting from the basics, what do we mean by capital market union? Essentially, we need an integrated security market in Europe that is a market where the low one price holds. The same, a given asset has the same price wherever it is traded, even if the actual market in terms of trading is fragmented across several platforms. It is not necessary, contrary to what many people think, that the actual platforms be integrated. What really matters is that price formation across these platforms occurs in an integrated fashion, so that the same price actually is holding at any given moment in time across the various platforms. And for this, we need conditions that, as economists, we know very well. One, the first one is that the rules of the game are the same, throughout the market, and also they're applied by supervisors or by supervisor in the same way. That people who are trading these assets have common information, both about the fundamentals, that is what is being traded, the assets themselves. So news about the company should be available to all market participants wherever they're located, and also information about the prices at which trading can actually take place, which is a non-trivial point. The other element that we need for a market to be integrated is that there should be a common post-trading facilities. Essentially, clearing and settlement should not create frictions across people trading in different segments of the market. And finally, the tax rules should be the same. And all of these conditions are jointly important, and they're particularly important in Europe because in terms of fragmentation of trading across trading platforms, Europe is in a worse position compared to the United States. The United States, for instance, has 3 listing exchanges, and in Europe we have 35, and we have 45 trading platforms altogether. So it is particularly important to ensure that actually trading of securities occurs, that all these platforms essentially form a single market. Now, the original rationale proposal for the Capital Market Union came from the five presidents report in 2015. And if we look back at why they were pushing for it, the basic motivations at the time were to enhance risk sharing and to promote systemic stability. Why risk sharing? Because it was recognized at the time, and it's still recognized today, that while in the United States a large portion of local shocks is shared, so for instance 60% of US state level shocks are shared, and 30% of these are shared through financial markets. Instead, in the Eurozone, only 20% of country level shocks are shared, and only 10% of that occurs through financial markets. And in Europe, it is particularly important, therefore, to have financial markets that ensure essentially the ability of people in different countries to share risk because of the lack of a federal budget. So this point was already recognized at the time, and it was one of the main rationales for the CMU plan. But the particular timing of the proposal had to do with the fact that financial crisis, in particular the great financial crisis, had underscored the fact that security markets can offer a spare wheel in a financial crisis. And Europe was in a way lacking this spare wheel, or at least did not have such such availability as in the United States of finance coming from markets, making up for shortfalls of funding from banks. Europe has been traditionally much more dependent on banks. We think that this goes back a long time, but as a matter of fact, as you can see from this figure, most of the dependence of Europe on banks, or the excess dependence relative to, say, the United States, has developed in the second half of last century and at the beginning of this one. In Europe, total bank assets to GDP grew from 200% in the 1990s to nearly 400% after 2000, whereas in the United States, as you can see in this graph, the time series is flat, around 100%. And if you look at the ratio between total bank assets and the capitalization of securities markets, that is the sum of the capitalization of stock and bond markets, you also see a similar pattern. You see that it grew very sharply, especially after 2000, which is not the case in the United States. So Europe is by now very heavily bank dependent, and this has become much more the case lately in the last 20, 30 years than it was before. Now, in 2015, policymakers realized, as I mentioned, that this exposed the economy to greater fragility, to greater dependence on volatile credit creation than it would have been the case if Europe had more robust securities markets, particularly bond markets. As you can see from these graphs on the right, both in the euro area and in the US, the supply of loans has been on a year-on-year basis much more volatile than the supply of the lighter line. I don't know if you can see it, which is the supply of debt issuance in bond markets. And the fragility of Europe became particularly apparent to policymakers after the great financial crisis. And you can see these two quotes, one by Jean-Claude Juncker in 2014, saying we should develop capital markets and reduce our very high dependence on bank funding. And Mario Draghi saying better to have a plurality of financing channels than to rely on just one. So this kind of spare wheel view of securities markets. And indeed, research confirmed these concerns. For instance, the paper that Thorsten was referring to before, that was published in Economic Policy by Sam Langfield and myself, made essentially 2 points empirically. The first is that countries that are more bank dependent, in the sense that they have a greater ratio of bank assets to stock and bond market capitalization, banks are more exposed exposed to systemic risk. So systemic risk is more of an issue. And this is particularly the case at times of crisis, especially large drops in real house and stock prices. And this is so a kind of financial implication of this overdependence on banks. But there is also a real implication in the sense that economic growth is not only lower, but it is more sensitive to housing and stock market crashes. So on that account as well, there is greater fragility. And this is also consistent with evidence by other researchers. Horda, Schulerick, and Taylor have a couple of papers where they make a related point that real estate booms and crashes fueled by changes in bank credit trigger larger and more persistent downturns than other recessions. So in a way, what policymakers were saying did have a basis in the evidence. Then the question is, what was actually done? And this is, I guess, probably something that we all share, this view that very little, not nothing, but very little has been done in terms of actually implementation of the Capital Market Union. There have been only a few and limited objectives that have been pursued, some valuable objectives, but they have, they're really partial ones, such as the European single access point, the creation of a consolidated tape, prospectus regulation, uniform prospectus regulation across Europe. The point is that even these objectives have been pursued at snail's pace. For instance, let me give you the example of the European single access point. So this is essentially a way to make sure that people trading in financial markets, in securities markets in Europe have access to the same information about companies, standardized information about the companies they would be trading. To develop this into something comparable to the EDGAR database in the United States, we will have probably to wait until 2028, and the completion of the project is planned to occur in 2030. So, and this was initiated several years ago. This is just to give an example of the somehow glacial type of speed at which this reform process has been proceeding. And why? I would say probably a combination of timidity by policymakers and pushback by incumbents. There are big rents at play here. Many people, institutions, financial institutions in particular, are making a ton of money out of fragmentation of financial securities markets in Europe. One example is, for instance, the idea of consolidating clearing and settlement facilities that would, remove a huge amount of rents that currently many financial market participants are earning to that. And moreover, there is the tendency, of course, of national regulators to defend their turf. They don't want to be left without power and job to perform. So the combination of this has led to the fact that in terms of rebalancing of European capital markets towards equity and bond markets, this has really not happened. If we look at this graph, the line, the green line, I don't know if you can see that, that is the ratio of equity and bond issuance relative to total non-financial companies financing. It is essentially flat since 2018, and is still at 10% versus 26% in the United States. And if you look at indicators of fragmentation, there is a whole set of studies that have been looking at studying and measuring fragmentation of financial markets. There are price-based indicators of fragmentation, quantity-based, and so on. And here I'm showing you one of these synthetic indicators. You can see that the lower line refers to indicator of financial fragmentation, financial market fragmentation in the Eurozone. as you can see, it has been even declining actually in the past few years, definitely not increasing. And these two things are actually related because the tendency of banks to focus on their home markets, what is called the home bias of banks, makes it so that their preeminence in financial markets is also a factor for fragmentation, for cross-border fragmentation. So in a way, bank bias and cross-border fragmentation are related phenomena, precisely because EU banks tend to be so home biased, not only in their lending policy, but also in their security portfolios, for instance, in the choice of their investment in sovereign bonds, as we all know. Now, at this point, we should ask, okay, what next? I mean, why at this point we are around this table actively discussing about why and how to relaunch the Capital Market Union project? There is a very important novelty, and it is the shortfall of European investment relative to what happens, for instance, in the United States, especially private investment, but also public investment, at a time when instead we desperately need a large increase in investment, both private and public investment. On the left-hand side graph shows what the EIB calls private productive investment. So it does not take into account investment in real estate and housing. And the red line shows the pattern for the United States and the green one for Europe. As you can see, both of the line dip very much at the time of the great financial crisis, but then in the US, there is a very fast recovery, and essentially the US investment as a fraction of GDP goes back to the previous trend line, whereas in Europe, private investment seemed to lag behind that of the United States. You can see that already after 2010, the United States recovered in 2 years from the pre-crisis, from the crisis. It went back to the pre-crisis high in 2 years, whereas in the European Union, it took 9 years, and it's not even clear that we are really above that level now. And the right-hand side graph shows similar figures for public investment. You can see that there is a persistent gap also in government investment. Now, why should we be worried about this? We should be worried about this because we are living at a time in which there are massive investment needs. And there are massive investment needs for 3 reasons. The first is that we need to invest massively in climate policies. And there are estimates which come from the European Commission that place this investment figure, the needed investment figure, in a range between 550 billion to almost 1 trillion, 912 billion per year until 2030. This is both for mitigation and adaptation expenses. Then at the same time, we should need to invest very much for the digital transition. Meeting here the specific targets of the digital decade decision alone is estimated to require 200 billion in investment per year. And then there is the issue of defense. Of course, we are only recently coming to realize how important this type of investment is, and some estimates place the required investment in annual outlays of 76 billion. It is not clear whether this would be sufficient. So, and notice that here both private and public financing are needed because some of these investments are really public goods. If you think of, for instance, of investment in the electric grid extension or military spending, these are typical public goods. And so at this time, it is particularly important to have well-functioning capital markets, not only banks that can actually help the financing of these huge additional investments. So I would say that the main reason why we feel collectively the urgency of going back to this issue of implementing the capital market union is that this is no longer simply a matter of raising economic efficiency, improving risk sharing, reducing systemic risk, as I was saying before, as it was actually, the perception at the time when it was first proposed. It is now a response, a necessary response to existential threats. Existential threats for the European Union as a political entity, also as a community. Because what are the existential threats? From climate, huge risks and losses envisaged to arise from global warming. The risk of being sidelined in international competition for new digital and green technologies, and maybe most urgent of all, military risk to European sovereignty and safety as the geopolitical map is being redrawn. And there is an added element of urgency that we all are aware of, which is the possible victory by Trump as the next president of the United States. That would make these risks, the last at least of these risks, maybe not only the last, even more serious. So in terms of then what we should be doing, the steps that are in a way required to the minimal steps, at least, that are required for us to get going on the agenda of implementing a capital market union are no secret. They are well known. The first one is to have a single regulator and a regulator applying a single rule book. And the most obvious thing to do is to restructure regulation of securities markets in Europe by having ESMA, entrusting it to ESMA, and restructuring ESMA itself, as for instance was proposed in the letter report, by giving it a governance which is similar to that of the ECB, by introducing 6 independent directors that are not appointed by individual country, individual governments within ESMA, to make it a truly European supervisory body. The second, so essentially follow the same script as the one that has been followed for the creation of the SSM. The second thing, as I was mentioning before, is to go fast ahead with already ongoing policy initiatives to create a single access point in Europe for all company level information, and to create a EU consolidated tape, which essentially would mean that people would be able, just as in the United States, to trade on financial markets at any given moment in time, obtaining the best possible price available across all the electronic platforms that are trading the same asset, which is essentially a situation of the national market system in the United States, which enables the United States to overcome the fragmentation of platforms and still have an integrated securities market, especially equity market. The other step that is particularly important is to unify the central counterparty platform and the central securities depository for equity trades to avoid the fragmentation arising from post-trading fragmentation. And then to establish a common and standardized EU-wide system for withholding tax relief at source. And I was learning just a few minutes ago that important steps ahead have been performed precisely on this front very recently. I was not aware of that. I knew that there was an initiative in this direction, but it is comforting to know that strides ahead have been made on this front. And last but not least, it will be important for securities markets in Europe to have as a reference point, central plank, so to speak, of these markets, a common safe bond, euro-denominated safe bond issued by the European Union that would be used to fund environmental and defense investment projects, and at the same time would provide, in a way, the backbone of the capital market union. So essentially, we could regard the issuance, the regular issuance of such a bond as a way to kill two birds with one stone. On one side, cater to the investment in environmental and defense investment projects on one side, and also provide this key element for a capital market union in the euro area and in the EU as a whole. And here I would like very briefly to touch upon an idea that I have put forward recently in a paper together with three co-authors, Irene Monasterolo, Antonia Pacelli, and Carmine Russo. We argue that one reason why the EU is well positioned in this moment to issue such a bond is that it has, or it can develop the fiscal capacity to back it. Because, of course, when you're proposing the issuance of an asset, you should ask what is the revenue flow that is backing, so that you can actually return this money if it is debt. And there is an obvious source of quote unquote EU tax revenue that could be used to back this bond, and it is the sale of carbon allowances traded on the European trading system, the so-called ETS, which, by the way, is a great quote-unquote invention of the European Union, and it is one front where Europe is, ahead of virtually every other country. The introduction of this market where these carbon allowances are traded continuously. Now, who is the issuer of these carbon? Who is the seller? It is already the European Commission. The only point is that the revenue of that it gets from selling these allowances is rebated back to the national treasuries. So if instead of rebating this money back to the national treasuries, the European Union, the European Commission were to use this flow of money to back the sale, the issuance of a European asset, European debt, which is devoted to essentially pursue the same objective, which is climate policies, how much money could effectively, how much debt could the European Union essentially issue? In this paper, we computed various possible scenarios. So we looked at the various different scenarios for the possible revenue that the European Union could be getting from the sale of carbon allowances. I cannot enter details because of time constraint, but even in the most pessimistic scenario, the present discounted value of this cash flow compares to the money, all the money that has already been budgeted for the European climate policies by the European Commission, and in other scenarios, it greatly exceeds this amount of money. And the European Union could auction debt backed by the ETS future sales revenues to fund its climate policies. And in this way, we would have at the center of the capital market union, not only a safe EU asset, but a safe and green asset, which could also be a useful monetary policy instrument for the ECB, because essentially whatever the ECB wants to do in terms of both asset purchases or quantitative tightening, essentially it could be done directly with this European Union issued asset rather than with individual country member states debt, which would eliminate also a lot of controversy in its policy. So is this, just a dream, or is it widely shared? My perception, maybe I'm an optimist, but my perception is that this plan, this is a minimal plan for the Capital Market Union, is by now widely shared by policymakers. If you look at recent statements by the European Council, the ECB Governing Council, the Letta report, there are, of course, emphasis on different elements, but by and large, I see a convergence. Actually, we're interested to know whether I can see there is some skepticism by Thomas, but it would be interesting to know whether this perception is correct or not. Definitely, unfortunately, here you cannot see this graph. It is widespread among economists. There is a poll which is routinely done among 80 European economists. It's done by the Clark Center of European Economic Experts, and they asked these experts a question, I don't know if you can read it, whether the creation of a more unified capital market in Europe with a common pool of capital, a single rule book, and strengthen the European Securities and Markets Authority, comparable to the SEC in the United States, would actually substantially increase the availability of capital to of funding to the new sorry, I cannot really startups companies in the European Union, and the net majority of the replies was strongly in favor or in favor, especially if weighted by the self-assessed confidence of the experts that were being polled. So essentially, there is a consensus for what it's worth among economists that actually this would be effective, that the elements that I was mentioning before would be effective also in changing the behavior of financial market participants, especially making funding available to companies, specifically the type of companies that would be more growth enhancing. Now, just a quick word on banking union. Now we have we often tend to forget that banking union is still far from complete. The SSM has aimed at securing prudential stability of European banks rather than overcoming fragmentation in credit markets. There are, however, proposals, and there is a very interesting proposal. It was made recently in a paper that Ignazio Angeloni produced for the European Parliament, who proposes the creation of a cross-border country-blind set of banking norms, a kind of shell of a legal shell that would enable banks with cross-border operation to truly operate without risking, again, ring fencing of the same type that banks such as UniCredit, for instance, experienced during the financial crisis in 2011. And why I'm mentioning this? Because I think that there is a close complementarity between capital market union and banking union. On one side, integrated securities markets can help banks to serve customers in other countries and even nudge some banks towards acquiring foreign subsidiaries, and so develop their structure so as to become truly, cross-border banks. On the other side, having banks that have cross-border operations is an important element to make continental securities market really integrated. So the two things really should go hand in hand. Let me conclude with just a quick set of remarks regarding the timeline. we have no hope of doing this if it's going to take another 10 years to do so, or even 5. I think the reasonable horizon to go for such a project should be a couple of years, 2-3 years, and we should agree on a tight timeline and stick to it. And the reason is the urgency of those existential threats that I mentioned before. We may not need to do everything at once. We could apply some reforms initially to subsets of players. For instance, we could do a little bit as we did with the SSM, where only the large systemic banks were placed under the supervision of the SSM. We could start placing the large multinational issuers and regulated markets with trading platforms in several countries under the supervision of ESMA. It's important to realize, however, that there are no low-hanging fruits. We should expect fierce opposition from incumbents that reap huge rents from the current fragmentation. And therefore, political will and awareness of those existential threats that I was mentioning is absolutely crucial. So the question is whether we are going to have such will, and for instance, whether we are going to go ahead with the coalitions of the willing, as it has been already mentioned by some, in case that there is opposition, especially by some countries to this plan. Of course, that's a question mark, but Europe has already showed that in the past that it can respond to existential threats. And so the question is, will it rise up to the challenge again? And this is what we should all debate about, whether this is going to be the case or not. Thank you.
Okay, can you hear me? Awesome. Thank you so much, Marco, for that enlightening talk. And thank you to EUI for having me, or should I say having me back. So to reintroduce myself, I'm Catherine Carlson. I'm covering financial services policy for Politico in Brussels. And so I'm very much, while not an academic, I'm at the coalface of these conversations happening every day. And I will say, if you're optimistic that people tend to be on the same page about what's needed to advance the CMU, I invite you to stay up until 4 a.m. following trilogue negotiations with me. So I won't repeat what we've already heard, but just a couple of opening remarks on where we're at. CMU is obviously not a new concept. A lot of people have agreed for a long time that it's what we need, and that further integration will be beneficial for the EU. But the situation now with the green and digital transitions and the war in Ukraine bringing defense to the top of the agenda means that we're all scrabbling around for how to fund the EU's political priorities without straining the public purse. Mario Draghi has said that the EU needs 500 billion a year and has questioned where that money is going to come from. He's said that private investment needs to fill the funding gap, and the 3 pillars that the EU has traditionally relied on to finance these priorities, cheap energy from Russia, cheap exports from China, and the US's defense apparatus, can't be relied on anymore in the same way. So where do we stand now that we're in an election year and it's a pivotal moment? Well, there's around 33 trillion euros of private savings in the EU that are currently held in currency and deposits. Every year, 300 billion of household savings are diverted abroad, mainly to the US economy. There's work ongoing to tackle the issue of fragmentation in Europe's capital markets, but it's maybe ironic to look at the fact that this work is itself fragmented. It's going on at the level of the Eurogroup, the ECB, influential policy reports under Draghi, Letta, France's Christian Noyer, and now also the European Council. The Commission will be tasked with advancing the agenda next mandate, but questions remain over the level of ambition, over which countries are willing to move forward on certain projects to advance the CMU, and on whether legislation alone will be enough to convince citizens to invest and businesses to stay in the EU. So with that, I'd like to throw it over to our panel, and I'd like to welcome Tanya Panova from the European Commission, Carol Lanu from the think tank CEPS, and Lucia Quaglia from the University of Bologna. I think you're all dispersed around the room, so this is a nice kind of front-facing format to have this discussion. So I'd like to kick off with quite a broad question about where we are and the current state of affairs. So from each of the panelists, I'm going to invite you to speak for no more than a couple of minutes, 1 to 2 minutes, responding to the question, what's gone wrong with the CMU? But before we do that, I'd like to have a quote from Finance Commissioner Marie McGuinness. She made a speech on Friday, and she said, "The single market is at the core of what makes Europe tick. So it's 4 freedoms we talk about: free movement of people, goods, services, and capital. But the truth is, today, we have 3 freedoms that kind of work better than most, and 1 that is not working at all, and that is the free movement of capital. It's still an aspiration. It's not a reality." I'm going to throw it over to Tanya first. What's gone wrong with the CMU, and do you agree with, I guess, indirectly your boss, Marie McGuinness?
Not indirectly, but directly, my boss. I have to agree with her. Well, if I may also briefly react to Marco's presentation, because I was following this vividly, and to offer maybe another alternative take at some of the things that Marco said. You know, why we started with the CMU. And by the way, we haven't started with the CMU in 2015. Before that, we had the Financial Services Action Plan. You know, so we've been integrating our capital markets forever. It's just in 2015, all of a sudden, we've given it a different name and we've given it a different level of political importance. One reason for that was because we were at the end of the banking crisis. So the crisis, you know, reforms were largely over and people were focusing on growth. How can you finance growth? You cannot finance growth with loans. You have to finance growth with equity. That's why capital markets came in the fore of the discussions. Second of all, we were in the midst of Brexit talks. So the referendum was looming, and I think it was important to raise the importance of financial services also in the eyes and let's say of the British community, given the importance that I think the City of London was bringing in terms of the role that it played in the capital markets in the EU. As many people actually say, we used to have a capital markets union before we lost the UK. And our capital markets union was in London. After 2016, we lost our capital markets union. And hence we were confronted with a new dilemma. How can we unify 27 very different capital markets? It was a completely different paradigm. And this is something what we've started with already in 2017, rethinking the whole concept of the CMU. Now, why didn't we get it? I think it's the right question to answer. Many people compare it with the banking union, and they say that we've achieved a lot in the banking union. We haven't achieved as much with the CMU. The difference is with the extent of urgency. And, I've heard, and yes, I hear it daily that people say, oh, CMU is very urgent. It's more urgent than yesterday. It's, it's increasingly urgent. It's not a nice to have, a must have, etc., etc. But the reality is that we're not confronted with failing banks. We're not confronted with lost savings. We're not confronted with a big social crisis, basically, at our doorstep. It's very different. It's very different. It's about foregone revenues, foregone investments, foregone productivity, if you wish. And this is something that is very difficult to grasp. People don't necessarily feel the pain of something that hasn't been realized. It's gradually eating into our growth, into our economy, into our economic significance globally. But we don't feel it. We're just gradually losing it. But there is no massive boom. There is no, banks going out of business with massive slogans. So that was part of the reason why we didn't get as far with the CMU as we did with the banking union. There was no one single boom effect that would all of a sudden make politicians realize that we have an issue. So that is one problem that I see. The other problem was that unfortunately today we have 27 different ideas of CMU, what CMU is and what CMU should be. Every member state sees CMU very different. And as long as we will have 27 different ideas of CMU, there will not be a CMU. I've been to many meetings where representatives of member states would say, yeah, that's all very interesting, but what is in there for me? This is the wrong perspective. It should be first, what is in there for the EU, and ultimately, okay, how I can benefit afterwards. Instead, we're having still this nationalistic debate. What does it mean for me? And part of the reason, and this is something that people don't like to talk about, is sovereign debt. Because having local capital markets is very cozy for member states because it allows them to control the way they issue sovereign debt. If you have a single market with multi-hub structure, where perhaps clearing is in one place, depository is in another place, and trading is yet in another place, you're no longer having this cozy relationship. You're no longer in control. And that is another issue that I think we see today, that there is this certain fear in capitals that that member states can lose control over how national debt is being issued and traded subsequently. So for me, another big problem is that there is no common understanding of the CMU. There is hence no willingness to go down the route of delegation of sovereignty and powers to the central common level. And that's why any debate, and I very much support what Marco said on supervision, couldn't agree more to that. And I'm not in favor necessarily of central supervision. What I'm in favor is coherent supervision and single supervision. So, however we design it, I think this remains to be seen. But supervision needs to be coherent. What we have today is very incoherent supervision that depends on the discretion, on the ability, sometimes even on the staff levels, of each national competent authority. And this is another problem that we have. And I stop there. Sorry that I've taken more time.
Thank you very much. I will let you overrun your slot because you're from the Commission, but I may not be so generous with our other panelists. So Carol, I'm going to throw it over to you now. A couple of minutes on what's gone wrong with the CMU. I mean, do you agree with my horrendous paraphrase of Tanya's argument, which is that we need a financial crisis for CMU to happen?
Maybe, maybe not. If you see CMU as hot today and there is no financial crisis. I mean, we see, of course, the problems which you just described, that we have more money being invested in the US than in Europe. But that's a big difference with 2010, 2011, that there was a big crisis which made us then move to the SSM. But what I see as difficulties, I mean, it will overlap a bit with what Marco said and what Tatiana just said. I mean, we just shouldn't underestimate, first of all, the vested interests, which there are today, are huge. Just if we have to break these vested interests, I mean, you have to break not a few eggs, but many different eggs. And I think the vested interest of exchanges, of back offices, of banks, of asset managers, it is enormous. And that's what I see, what I feel in Brussels. They are doing whatever they can to stop this from happening. Certainly, if you see the debate now on the retail investment strategy, on the fees on funds, what the banks are doing to kill it is enormous. And it's just now, only very recently, I was speaking about this to Tatiana, that McGuinness has made a strong speech saying explicitly, we're very disappointed, only in April, we're very disappointed by the position of the banks. But they have tried to stop this now for years to apply basically MiFID rules, which were there already in 2004. The MiFID 1 rules had clear rules preventing conflict of interest. Only one member state, or two, the UK as well, the Netherlands and the UK, had correctly implemented this. According to my view, all the others have allowed conflict of interest to be very pervasive in the offering of investment products, which is kind of these topical products, these topical issues at the moment, to be presented to retail clients. Basically, if you want to have a well-functioning securities market, one of the important things is price competition. To have price competition, you need to have unbundled prices, but most of our retail investors do not have unbundled prices for a long-term savings products, of which Letta now speaks, or of which Also, the Eurogroup now report now speaks. If you really want to know what is the cost of your retail investment product, you really need to go to the prospectus and you see it. But for most investors today, the annual management fee for a retail investment product is around 1.6 to 1.8%. And even until a few days ago, get EFAMA, which is the Asset Management Association in Brussels, which says the costs are so much, which include financial advice. People buy an investment product probably once, keep it for 30 years, they pay financial advice 30 years, but they got financial advice once. But banks have been doing, also in insurance companies, all they could in Brussels to prevent unbundling, to prevent strong price competition in this. And if they cannot get it from Brussels, then they say, look, then we will be invaded by the American asset manager. Because if you look at the difference in price competition in the US to Europe, the average cost for an investment product in the US is about 0.4, 0.6%. In Europe, it's 4 times higher. So that is one fundamental thing which you heard Le Maire speaking about, the Eurogroup has spoken about, Letta has spoken about, and I'm sure Draghi will say it as well. So vested interest, but also exchanges, CSDs. CSDs are huge monopolies in the national markets. And if you say, but why is this that there is no interoperability? If you look at the CSDR, which is the Centralized Securities Depositories Regulation, says very clearly there should be interoperability. But interoperability has not been enforced. What is interoperability? That you can buy shares here, you can settle them there. But you cannot do this today. You can hardly do it. All maintain as much as they can the vertical silos. And a good example recently is, for example, Euronext. Euronext bought Borsa Italiana. Euronext, which is the example of the the horizontal platform. For Italy, they have maintained the vertical silo because they know it very well. They get a lot of revenues from settlement of the Italian shares in Monte Titoli, rather than having them in an integrated settlement entity at the moment. The second thing what I wanted to say is, I think there is a lack of understanding what market regulation is about. I mean, they think we need to do the same like we've done with SSM. We just have one single system of supervision, one system of regulation, like the CSDR, the CRD, the Capital Requirements Regulation for banks, and it will work. No, market regulation is a matter of regulating many different intermediaries. It is a market. It's not an institution you regulate. It's a series of markets. I mean, and in the market, in a capital market, you have, of course, the banks, you have insurance companies, you have institutional investors, but you also have analysts, you have accountants, you have auditors, you have the rating agencies, you have the financial press, you have so many different actors. And Europe, I mean, is having a hard time, but we underestimate. Before you have this all in place, it takes a long time. And also the United States took about, I think, 30, 40 years before they had a system in place. After the Great Depression in 1930, when they established the Securities Act, it took them another 40 years before the market started to pick up, because before they had the adequate environment in place and before they started to have an attractive capital market. So it is a bit the same in Europe. It takes time before you have this entire system in place. And it's not only, Marco, it didn't only start in 2015. It started already in 1992 with the single market. The first rules, first of all, the usage rules, which is one of the most successful capital markets rules which we have on the investment funds, date back to, I think, 1987. We had a single prospectus rules, the first prospectus rules already, I think, in 1986. But then we had the ISD, which was the predecessor of the MiFID, which was 1992, came into force in 1994. MiFID 1 we had in 2004. We had MiFID 2 in 2018. If you ask me, if you look at all these rules, a big issue is enforcement. I mean, like I said, for CSDs, you have rules, and Europe produces massive amounts of rules, continues to produce massive amount of rules, but enforce them. And if you hear a bit about the criticism of ESAs, is that, and of ESMA, of EIOPA, and of EBA, is that they focus far too much on basically helping the Commission in writing delegated acts, implementing acts, but they don't do sufficient enforcement work. And if you look at, for example, I looked at it yesterday, enforcement work by ESMA, they did a few important cases, but basically they should do many more. They did a Wirecard case, which was very important to say, look, Germany, BaFin, you haven't done your job in controlling Wirecard and then what the auditor did, which, by the way, is a thing which has not been harmonized yet, the role of auditors. We have different regimes in Europe, the same for accounting standards. And then secondly, they had, I think, as far as I know, there were two cases they acted against the Cypriot authorities, and they said to Cyprus, look, you're allowing issuance of funds and you can hardly supervise what you're doing, which goes extremely far. I mean, like the same for ESMA against BaFin, to say to the Germans, look, guys, to Scholz at the time when he was Minister of Finance, at the time in charge of supervising BaFin, to say this openly, that goes very far. But I think ESMA, as well as EIOPA and EBA, will have to do much more what I call peer pressure and giving warnings to authorities if they don't do their work. And I mean, there are many other examples in Brussels which I hear about very often. For example, Luxembourg, which also issues plenty of funds. Do they have the capacity to supervise what they do? That's probably another one, but there are certainly many others.
Thank you, Carol. I'm
I
going to
could say
throw it
many
over
more
to
things, yeah.
I know, we'll get there. Mostly for the
If I
issues.
could add one thing, Catherine, which is we also have to see there is what I think Tatiana said a moment ago. There is a huge diversity in market development, which makes it very difficult for the Eurogroup and for the ECOFIN Council to say what is now the model which is adapted. I mean, with banking, we don't have this so much. Of course, you can simply say we need to have the 8% capital requirement, and then you can move around all of the EU. But if you have a market which is hardly developed in Southeast Europe, as compared to, for example, the North, by the way, the Swedish model, the Danish model, they are very developed capital markets, and it functions. But then if you go to the Southeast, the market development has hardly changed over the last 20 years. So what do you do as a regulator sitting in Brussels? How can I find a model which is adapted to, say, Greece, which is adapted to Bulgaria, to Romania, and which at the same time is useful for Denmark and Sweden?
Thank you very much. Lucia, is this an issue of vested interests?
Thank you. So first of all, thank you for inviting me. Since I am a political scientist, I will focus on the politics of CMU. And my overall opening argument would be that some of the political obstacles that got in the way of the development of CMU in the past are still there. So I see three main political hindrances to the development of CMU. The first one, the other speaker have already alluded to, is a distributional issue, in the sense that although in the medium and long term, the European Union as a whole will benefit from CMU. In the short term, there are potential winners and losers across the member states and within the member states. So the expected winners are in favor of CMU, but the expected losers, so those who are likely to benefit less from CMU, if we want to put it in a sort of more positive way, they mobilize to slow down the process and actually water down the project as well. The second political obstacle to the development of CMU is really a political obstacle, in the sense that has to do with the different preferences of the member states. And that also has to do, or partly explain, the half-hearted political will to develop CMU. So if we look at the council level, over the last, 3 or 4 weeks, there were several reports of council meetings that didn't go that well because different member states had different views. I could not agree on the subject being discussed. And also the coalitions which are in favor of CMU or against CMU, they shift depending on the specific dossier of CMU we are talking about, depending on the specific issues. And that makes horse trading, or in a more sort of politically correct way, issue linkages more difficult. The third point, actually the second point in terms of lack of political will, the European Parliament in the past has been verbally supportive of CMU, but then we don't know what will happen in the future after the election of the new parliament. Maybe I could come back to that issue later on. And then the third obstacle to CMU has to do with bureaucratic politics, meaning that the national competent authorities are reluctant to shift part of their competencies and therefore also resources to the European Union level, to be precise, to ESMA. And on top of this purely bureaucratic politics argument, it is true that even though progress has been made in terms of convergence of supervisory practices and the development of a common supervisory culture, member states and national competent authorities, to be precise, still have somewhat different supervisory paradigms, and they also have somewhat different institutional design in various aspects, including, for example, the degree of independence from the political authorities. Final point, well, actually a couple of points. One point which has been mentioned by Tatiana before is the Brexit effect. So I want to elaborate on this. And the final one has to do with the sheer complexity of capital markets union, in the sense that it's like, you know, a giant jigsaw or puzzle with several moving pieces which have to fit together at the right time, at least with the right sequences, and that makes the project even more challenging than it would be otherwise. And I think I will stop here.
Thank you very much.
Excuse me, Catherine, but you suppressed me?
Sorry,
For
who
reason?
is?
Stefano Micossi. I was a speaker after Karel, but you have simply suppressed me. Is there any reason?
I haven't suppressed anything.
Well, you did suppress me. You did not give me the floor.
Yes, Stefano, you're in the second panel.
No, I'm in the first. I'm in the first panel. When
We,
did you move me to
we
the
spoke
second
about
panel?
this by email.
Stefano, sorry, you're in the second panel, sorry.
I'm sorry for the miscommunication.
I have the program here. I was in the first panel.
No,
If you
sorry.
think I'm now in the second panel, it's fine for me. But
Okay, we
was
look
not
forward
on
to speaking with you again shortly. Moving on. Yeah, I think, Lucia, you raise a really interesting point about fragmentation and about the conflict between different national perspectives, particularly in my own work following a lot of legislative negotiations. The kind of conflicts that often emerge are one between larger and smaller countries, and one between different countries which are, let's say, all fighting for a piece of the same pie. Maybe they're dependent on the same industry. I mean, we most recently saw this at the UCO in April, where a group of smaller countries stopped France and potentially Germany from moving forward with the issue of central supervision. I mean, one of the diplomats said to me at the time that there's no trust there anymore, and that until there's trust, it's not going to move forward. So my question, and I'll throw it over to Tanya first, is how do we get past this fragmentation?
That's an easy one. I think first and foremost, we need to agree all on the objective. I think currently there is no agreement on the objective. As I said, every member state sees the CMU very different. Luxembourg sees it very different from France, and possibly France sees it very different from Germany. It's not always small versus big. Sometimes it's also, there is a disconnect between, you know, within the big ones, because and there is a lot of this now ongoing. There's increasing specialization in the way capital market union is being built. So, you know, the movement, the shift from, you know, a single hub model that we had with the City of London towards multipolar or multi-hub model allow different member states to develop to a certain extent, you know, their specialization. And what we see increasingly is that those member states are trying to protect the model that they've assumed, you know, after Brexit. Some of them have already been developing it before Brexit, but Brexit allowed them to strengthen the model. And with that, the negotiations that we see and the positions that they take often are influenced by national interest. Karel mentioned vested interest. We also see a lot, let's say, where member states defend also the interest of the industry, you know, of the prevalent industry interest, which in principle we shouldn't see, because we should all be thinking as Europeans, you know, in the common kind of policy, with a common policy objective. Now, what we see is 27 independent, not in a good sense, but independent, not connected views that are trying to protect local monopolies and local views. And this is not conducive to an agreement. So first and foremost, we need to agree all on the objective. And I think the fact that this discussion has been now escalated to the heads of states, and Lucia mentioned the European Council that has discussed now the issue first in Eurogroup in the inclusive format in March, then in European Council in April, and is going to discuss again in June, suggests that there is, I think, a common understanding that this issue is so important that it needs to be escalated at the highest level. The problem that I see with this, however, is some of these debates become too simplistic. Carol mentioned the complexity of the CMU. It's incredibly complex. We are working today, you know, on tax matters, on company law matters, on insolvency law, on financial law, on financial education, on employment and pensions, on so many things. When this debate gets escalated to the highest level, it by default gets, you know, a bit muted. And hence some of the tensions tend to disappear, not because they're solved, but because they're generalized, the difficulty that lies underneath. So first and foremost, I think, you know, an agreement, high-level steer, and my Director General always reminds us of the introduction of Euro. It was a difficult moment, but once the heads of state decided we want Euro, things went well. So I think what we need a realization that irrespective of the field of where you are, whether we're talking to justice ministries or to tax attachés or to experts, you know, from labor ministries, there needs to be, you know, the interest of capital market at hand, and not, you know, yes, but we need to ensure that we protect our company law structures that have developed for 2 centuries and things like that. So I think as long as we have common understanding there, not the generalization, but a mandate, clear mandate to give preference to CMU objectives over other objectives. And that is difficult because often other objectives are, you know, very important, you know, social objectives or, you know, defense objectives or, you know, foreign interest, foreign policy objectives. Those objectives are also very important, but sometimes you need to, you know, define the order of priority. And by defining this order of priority, we as experts would get the mandate to work then constructively and solve issues one by one. Because at the moment, you know, we get into discussions in council, and every council working party has experts that try to defend their area of, you know, law in the way that they find the most comfortable with. And they don't get any instruction from, you know, high level that they need all of a sudden take a different stance, take a step back and approach these matters differently. And this is the issue that we're seeing today. We need clear high level steer, clear mandate, clear priority that CMU is something that we need to achieve. Thank you.
Thank you very much. Lucia, I'm going to throw this back to you now. I think you raise a really interesting point, Tanya, which is about the sheer number of fora that this issue is being discussed in at the moment. Something I see when I talk to people in Brussels day to day is that everybody's got an agenda, right? Everybody has a different opinion about which exactly is the best way forward. If you ask a national attaché, they might give you a different answer from a finance minister who might give you a different answer from a head of state. So, Lucia, do you think that this is important to have a critical mass of people who are getting behind the CMU project, and the more people involved, the better? Or is this an issue of too many cooks spoil the broth?
Okay, thank you. So I think it's sort of more of the latter case. I would also like to pick up a couple of points that Tatiana made, and there are different visions of CMU, so it doesn't simply boil down to vested interest, in a sense that member states, but also policymakers, industry stakeholders, they have different views about what CMU should be, so what should be the objectives of CMU, and also the institutional design of CMU. So I made a sort of a list of some of the meanings which are often associated with the term CMU. So capital market integration, targeted regulatory harmonization, targeted centralization of supervision, consolidation of financial industry by creating cross-border players. But also if we look at the latter report, a European Savings and Investment Union to be complemented by European safe assets. Here I'm thinking about the speeches by the ECB senior official. Something that also Marco mentioned is complementing banking union. So it's a bit of a Gladstone bag where policymakers and stakeholders try to put in the things which are more important to them, and that actually makes the entire process more difficult. Let me add one point. If we look back in a sort of historical perspective, meaning from 2014, when the project was first launched, different visions for CMU were there from the beginning. So Hill was the British commissioner at that time, and his views of CMU, which also reflected those of the UK, but also of other member states, was a CMU that would not require major institutional developments, that would not require much harmonization. It would be a CMU based on the removal of barriers to cross-border trade. Whereas for other member states, but also policymakers, stakeholders, CMU also implies some level of institutional building, so notably strengthening the competencies, resources of ESMA. So that's a sort of been one of the problems that was there when CMU was conceived, and is still actually there.
Thank you very much. I'm going to throw it back to Tanya now. And McGuinness also in her speech on Friday, sorry to keep bringing up your boss when she's not even here, but she raised the point in her speech about when the Commission put forward instant payments, the regulation. What she said is that the technology already existed, but the market wasn't introducing it across the EU, and that what they had to do was have a push from the Commission to give the markets a nudge to actually roll out this technology. When it comes to CMU more broadly, can we regulate it into existence? Has this worked? Or do you need market change? Do you need a cultural attitude to change to be able to move forward with this project?
I mean, when you put it like this, it sounds really bad that we would regulate something into existence. I don't think we ever try to regulate for the sake of regulation. It's never good. I also use the phrase, we never harmonize for the sake of harmonization. We try harmonization to remove barriers and to support, the flow of capital across member states. We don't regulate into existence. I think this would be the wrong way to put it. But without having common rules and common implementation, enforcement and supervision of those rules, how can you expect the market to be truly integrated? I mean, often we're being compared to the US, and by the way, I hope it will take us a bit less than 100 years to build our CMU, and I think it took the US 100 years to have a single insolvency code, by the way, which was national back at the end of the 19th century. Ultimately, if we want to compete with the likes of the US, soon China, soon India, we have to deeply integrate our legal systems. That means, we need to make sure that our operators, that market actors, apply the same rules, and they apply them in the same way. Because if you don't have same rules, if you don't have the same implementation and enforcement of those rules, you're creating inefficiency in the market. You're creating distortions in the market. You're basically creating possibilities for arbitrage. So people would be choosing to go to a particular market, not because companies there are representing the best value and are likely to create the highest growth. No, because you would be subject to loser supervision. And that is wrong, because you would then, create capital flows for all the wrong reasons. And that is the beginning of the end. So I think first and foremost, we need to create, we need to remove the frictions. And some of these frictions are caused by divergent rules. So in order to remove frictions from divergent rules, you have to apply legislation. You have to legislate, because otherwise, how can you remove legal barriers? But legislation alone is not enough. That's very important. You need to work on implementation, on enforcement of the rules. That's correct. You also need to work on the mentality. I mean, we don't have the equity culture in Europe. People don't invest in Europe. People don't trust capital markets. It's not just member states who don't trust, I think, the EU or centralization or ESMA. It's also European citizens do not trust capital markets. I think we have a culture where people go and save. They don't invest, and this is something we have to work on as well. But this may also not necessarily rule out some legislative interventions on the side. Now, you cannot change the mentality by legislating, but you can create incentives for people to gradually develop. We have been talking for a long time about auto-enrollment in pensions, something that actually allowed to develop the culture of investment in the US. Similarly, in Sweden, because they have a super well-developed occupational pension pillar. Similarly, in the Netherlands, people invest there because it became a household issue, a household topic. People discuss these things because they like to talk about pensions, about, this is something part of a daily life. You don't legislate those things, but maybe you can create conditions for the development of occupational pensions. You can, allow people to be enrolled so that you drive behavioral change with it.
And let me ask, just to follow up. So lots of these political level statements, whether we're talking about the Eurogroup statement, ECOFIN conclusions, the UK statement, a lot of them talk about what the Commission's going to be doing and all of the lovely jobs that they at political level are going to give you to carry out in the next mandate. What can you say about what your expectations are for what's coming?
This is a great $100 million question. And I think somebody said, I think you Catherine said, it's actually very fragmented in the way we are collecting input. It's no different from any other time when we are collecting input. Everyone who has something to say is saying something. So, I mean, we're listening to everyone who has something to say. Heads of states, ECB, Letter, Draghi will soon have something to say. Noyer said something recently. Ultimately, we as the Commission have the power to bring forward legislative proposals. And we will, of course, consider everything that is on the table, but we will do what we consider is right for the policy objectives we want to pursue. Of course, we come under political pressure. We cannot ignore entirely what the heads of state are telling us to do, but we will not, and this also has to do with treaty freedoms and treaty obligations and rights. We have the treaty right of initiative, and we will exercise this right. Now, there have been different topics that have been floating around, supervision being one, very contentious, securitization being another. There's been a talk about long-term investment product, the role of pensions, something that the industry is calling for, because I think there is a realization that there is a gap. There's been a talk of consolidation. I think it comes across in different ways. I think Lagarde mentioned it, an explicit call to consolidate post-trading and trading. I think Noyer came back to the same idea. So I think we have a plenty, a rich range of ideas on the table that we will be assessing. Ultimately, everything will depend on the next Commission, what the political steer is going to be, who the next president of the commission is going to be, who the next commissioner for financial services is going to be. And ultimately, also what, and I think Lucia mentioned it, what the European Parliament would look like, because yes, of course, we propose laws, but we don't decide on laws. We need the agreement of member states and the Parliament. And a lot depends on also how the powers are aligned in the Parliament and how the Parliament works with member states. Because if the Parliament cannot work with member states, you have a blocked proposal. And that's something we don't want either.
We're almost at the end of our time slot and people's coffees are calling. So Carol, do you have any final thoughts on this issue? Where are we going next?
I have a very simple
And yes,
question.
I will eat into
I'll
eat into our coffee break by a couple of minutes to open the floor to questions, but I just want to get Carol's thoughts first on
it's
where
more
we're
a
going.
question which I have to Marco, to Thomas, and to Tatiana, of a kind of an important solution which could bring us forward is what is now debated a bit, is the governance of the ESAs. Just the fact that there has been insufficient peer pressure by the ESAs is, of course, something which we've seen with EBA and the creation of the SSM in 2012, is that basically it's a board which is, where all the supervisors meet. And nobody wants to target another one. So in the end, we don't manage to take any decision. And the exceptional cases which I've mentioned, yes, I don't know why they came about. So my question is to Tatiana or to Thomas or to Marco, do they see this as a real problem? And do they think, let's say, that we can reform this decision-making structure to move towards a more SSM-like structure where we can act much more rapidly and much more decisively?
Yeah. We're going to come back to this topic on the next panel. So in fact, Tatiana, I'm going to let you respond now because you're not on the next panel, and then the other ones we can save it for after the coffee break.
So maybe to be short, and I'm going to share with you my views. Of course, I'm not speaking for the Commission. Do I think that the current governance of ESMA is flawed? Yes, I do. The Commission tried to solve the issue back in 2017 when we tabled the ESAs review, the famous or infamous ESAs review, when we tried to tackle the issue of governance unsuccessfully because of the resistance of member states. We've also tried to tackle the issue of insufficient toolkit and powers that ESMA has, ESMA and EIOPA. Again, rather unsuccessfully. There were limited improvements, but very limited, and that's where we left it. And we also tried to tackle funding, because, I mean, this is, Carol, you were talking about enforcement. Oh, let's make sure that ESAs enforce. It's all very good, but to enforce, you need staff. You mentioned the wildcard peer review. ESMA today can do the maximum of 3 peer reviews per year. Yes, yes. They don't have the capacity to do more. It's a very laborious exercise. In order to do more of peer reviews, which are effectively basically a check on other supervisors in specific areas, how supervisors are doing their job. So it's basically supervision of supervision to ensure converging outcome. This is super laborious. It requires a lot of staff, and ESMA currently doesn't have the capacity to do this. Let's not forget what the funding arrangement of the ESAs is. It's 40% EU budget, 60% comes from member states. What happened last year that ESAs had to, ESMA, return to us 1 million of EU funding, of EU budget money, because member states did not come forward with the remaining 60%. And they cannot spend the EU money unless member states match with 60%, the 40% from the EU budget. So this is the problem. This is part of the problem. If you don't resource properly ESMA, you cannot empower ESMA and give the tasks, additional tasks to ESMA that ESMA will simply not be able to deliver upon. So let's first reform indeed ESMA. Let's give it powers and adequate funding structure. But again, I'm talking my personal capacity. I don't know what the next Commission is going to decide. But yes, this is my view, at least personal view.
Okay, thank you very much. We have a longer second panel, so I'm going to anticipate more time for question and answer in that panel. But just before we close, do we have any very brief questions for the panel? Yes.
I have a very quick question for Marco for his presentation. Do you see, and actually it might be a question also that we come back to later, do you see capital market union only as the public markets, or how do you think about private markets? I mean, be it private credit, be it venture capital, and other kind of funds, which are not necessarily because again, there might be difference in terms of both the economic analysis that you did, but then also in terms, of course, the regulation and in terms of the policies to be implemented to foster this segment.
I would reply that, the focus should be on public markets, which also provide a possible outlet, actually the main outlet for, venture capital and stuff like that. So I think where capital markets work well, that enables venture capitalists, for instance, to recycle their capital quickly and operate efficiently. So I don't think that we should not be overambitious. This is something that I think is important. Many of the things that we have mentioned are super important, like those that Tatiana has actually mentioned right now, the resources to be given, the governance of the assets and so on. These are super important, but I'm a little bit afraid that if we overextend our definition of capital market union, here we come to your issue of the definition of capital market union, to be too encompassing, too ambitious, we are not going to get anything done. So I think we should aim for like a minimal set of objectives in terms of like integration of public capital markets, and then let essentially the market operate and produce its consequences. So of course, this is up for debate, but that is my view. There is a bit of a tendency to put too much meat on the fire, and we're not going to get anything done then. And that at least my fear.
Okay, we have another question over here.
Yeah, my question's also for Marco. It really has to do with the diagnosis rather than.
Sorry, could you please introduce yourself?
Oh, sure. Sorry, Jonathan Zeitlin. I'm a visiting fellow at the Schuman Center. It has to do with the diagnosis rather than the remedies. You presented a very interesting chart towards the beginning of your presentation about showing that the divergence in terms of bank-based rather than capital markets funding between the EU and the US seems to be of relatively recent origin, since around 2000, if one believes those figures. And what the charts seem to show is the divergence was driven by an increase since around 2000 in the proportion of bank-based funding in Europe. And if that's true, how does it fit with the diagnosis of what are the problems and barriers to larger reliance on capital market funding in the EU? Because it doesn't suggest, for example, that things changed in the US. The US levels of capital market funding just kept pace with economic growth. So how does that fit with the story that we have all been discussing, which is that there are many barriers for companies and households to make use of integrated capital markets in Europe?
Oversimplifying answer, the answer is that mostly these banks are very much focused on their home market. And there is very little or relatively little cross-border operations by these banks. And on the other side, the capital markets are relatively underdeveloped and relatively, non-integrated or fragmented. So that kind of explains the puzzle. We have these big banks that, however, are very much focused on their, home market, and both in terms of lending and in terms of security issuance.
Sure, but if they more so after 2000, what accounts for the divergence that you show?
One answer is one possible answer is probably not the only factor, is the political favor towards national champions. Essentially each there is a strong and increasing tendency towards an alliance between national politics and banks, and we have seen that in several instances, favoring essentially very often the survival of banks that should not probably survive, that should be shut down, and instead are actually kept in life, or they are either bailed out, or they are acquired by other national banks and so on. So it's essentially this tendency of national governments to protect the home industry, the banking industry, that has actually led to this, at least contributed to this growth.
Okay, thank you so much. And I think we can continue this conversation over the coffee break. I will let you go, and we will be back at 5:30 for our second panel. Thank you so much to all our panelists. Thank you all. Thank you. Thank you, Torsten. I hope you enjoyed the coffee break. Let's get going for our second panel. The title of our second panel is How Do We Get There? Next Steps for 2024 and Beyond. And I'd like to welcome our remote participants for this panel. We have Nicolas Veron from the think tank Bruegel. We have Lorenzo Benismaghi from Societe Generale. And making a star appearance again, Stefano Micossi from EUI. Can I see him this time? Do we have Stefano? I'm not seeing him. We will push on with no Stefano and we will see if he arrives. But in the meantime, I am aware that we didn't have much audience Q&A in the first panel. I would like to try and make this one much more active. So please do feel free to raise your hand if you have a question. I would like there to be more interchange between us. So we will get going for that. So I'm going to open with a quote again. I promise I won't do this for the whole panel, but I think it's an illustrative one from Christine Lagarde at the end of last year. This is in her famous speech about CMU, and she said, to mitigate fragmentation in EU capital markets, a more ambitious approach should involve the creation of a single rulebook enforced by a unified supervisor. She also said, a truly European capital market needs consolidated market infrastructures. And so I'm going to throw it open to the panelists for a couple of minutes opening remarks. I'd like you to respond to the question, what needs to happen to advance the CMU project? Nicola, I'm going to go to you first.
Well, thank you so much. I should mention that I'm not only working at Bruegel, but also at the Peterson Institute for International Economics. They both pay me. I love them both. But more substantially, I should say I'm sorry not to be there in person. I would love to have been with all of you. I couldn't make the logistics work. Apologies. Now to the question. I think the quote you gave from Christine Lagarde kind of gives my answer. And I was very struck in the previous panel by Tanya's suggestion that for something valuable to be discussed and decided at the leaders' level, it has to be made simple. I actually happen to believe the situation is relatively simple. One thing we learned is that there are high-hanging fruits out there, things that we all would like to see for capital markets union and that are genuinely important for capital markets union, but will not happen for the sake of capital markets union. And that includes taxation, insolvency law, pension finance, housing finance, and of course, the highest hanging fruit of them all, which is the fiscal union. So all of these things would be enormously helpful if they were to happen, but I think the way Tanya put it is very simple. They should decide a mandate in which, I quote her, give preference to capital markets union objectives over all other objectives, including social objectives, security objectives, any other public interest. That's obviously not going to happen, and probably it wouldn't make sense. So the question then becomes, what can be done that makes a difference? What can be done that makes capital markets union real, will not tick all the boxes, will not solve all the problems, but makes a positive difference in terms of integration. And when you start looking at the problems this way, something very interesting emerges. What emerges is that the EU doesn't have a mandate for harmonization or centralization in taxation, in insolvency law, in pensions, in housing, and it doesn't have a fiscal union. All these things are heavy-duty political items. Capital markets union will not create that mandate. What the EU does have is a mandate for financial services regulation, and that has changed in the last, 30, 35 years, maybe less, certainly since the creation of the euro, accelerated by the Eurozone crisis, and importantly, accelerated these days by the geopolitical context. And I think this is where there is scope for action. So Lagarde identified it correctly, where action can be taken that makes a difference and is not so high-hanging that it's out of reasonable consideration is supervisory integration. This is where the action is. I think Scholz and Macron are on the way to understanding that, or more probably have understood it. I think the resistance is vast. And for reasons that have been discussed in the previous panel, but it can be overcome, and it's not higher. It's certainly not higher than the resistance to European banking supervision that was decided in 2012. But echoing Carl in a different way, I will say, actually, you need less pressure at this point, and I'm happy to expand on that point later on. I want to be brief in my initial remarks. You need less pressure now to create supervisory integration, which is basically, a reformed ESMA 2.0 with a much more expansive mandate, expansive with an A, and you need much less political energy to do that than was needed 12 years ago to create European banking supervision. Let me stop here because I hope we'll have a very conversational interaction, and so I hope to be given the opportunity to come back.
Thank you, Nicolas. Seeing as we have Tanya in the room with us, would you like to respond to anything that Nicolas said before we go to Lorenzo?
Yeah, I would be happy to.
I have some more for Tanya if she wants to wait. I have quite a few things for her too.
Okay, let's go to Lorenzo first.
No,
You make a compelling argument.
Yes, no, because I have no, I think, when we had a discussion on monetary union, there were two opposing positions. One was the institutional view, and the other was the economic view. The institutional view was you need to change institutions, and then monetary union will happen, and all the rest, all the problems will be solved. And the economic approach was, well, you need first convergence, you need to do a lot of things, and monetary union will be the conclusion of all this. By de facto, we will have monetary union. And in fact, it's something in the middle, but you need somewhere to start from institutions. And on that, I agree fully with Nicolas. Those who start from taxation, bank subsidy rules, basically, I put them against the opponents of capital market union, because these will lead to having a union in 1 century. So the answer to the question is you have to fix the things that have not worked or that didn't prove functioning so far. And I think starting from the economics analysis of it, I mean, going to Marco Pagano, I mean, all he said is right, but things are not happening. But maybe in economic terms, the reason is that capital market union is not Pareto superior to the status quo, or at least is not perceived as Pareto superior, because there are some losers and some gainers. And unless we explain very precisely who are the gainers and who are the losers, we won't make progress. And the losers are not only the supervisors. Of course, they represent and they are active because Turkeys don't vote for Christmas. But it's much more complex. And unless we understand who loses and explain it and bring it to the heads of states, because again, they have to make the decision. Unless this is done, we will not make progress. So I think first we have to start explaining clearly who loses. And clearly there are the supervisors, I would say, but there are some market players. And we have to explain whether what some market players lose, and these may explain their opposition, whether this is relevant for the country in which they are and for the union in which they are. For instance, and I don't know if this is Chatham House rule, by the way, or not.
No, we're on the record.
Okay, so it's complicated to say things. But let's say if you have a big market infrastructure that is regulated by the national authority, the fact that they would be regulated by a European authority, of course, it's something that the market structure doesn't like. And this is the reason why they lobby against it. And this is the reason why the supervisor lobbies against it. But is this materially relevant or not? The other opponents are countries. Some countries are against because they are able to attract industry, especially non-EU industry, through regulatory and tax advantages. Now, this has to be explained very, very clearly. So is this material to the opposition? Is this material to the opposition to going towards capital market union? Are there ways to compensate for this? And so on and so forth. So I think the first thing is we need to be clear and explicit. We cannot be shy just because we are on the record or much. I think the second point is, I mean, Tatiana said we have 27 views, but what we miss is one view from the European Commission in particular. What's the view of the European Commission? What do they think? And the fact that, you know, maybe they went to the European Parliament and they got bogged down, is that an excuse for not going again? Or, as she said, very diplomatically, it will depend on who the next commission is or who the next commissioner is. Because the commission is political, and in the end, I think personally that it's difficult to have progress in the capital market union unless you have a commissioner, not only who has a view, but which has no, he or her has no real political advantage or disadvantage from this from capital market union moving on, which means
I'm anxious to give Tanya the opportunity to respond here.
Yes. Unfortunately, I forgot to say also that I have to leave, so I need to listen to her answer. But unless you have a commissioner who comes from a country that doesn't lose too much from capital market union, we won't go very far. I think the last point I would like to make is that one of the things we haven't realized is that possibly those that are against the capital market union are not the Europeans, but they are outside Europe. Because those outside Europe, and Karel mentioned there are many categories, you know, asset managers, private equity, rating agencies, auditors. If you look at all these categories, the big players, they're not Europeans. And what do they gain from not having a capital market today is that they can choose the supervisor, they can choose the rules. So they have no advantage at all in moving to a single capital market. So I think that we need to explain all this. It hasn't been explained enough, on the contrary. The final point maybe is to Marco Pagano. The fear of not enough capital being put to stimulate investment, to finance investment, is not understood and is not perceived and is not trusted. I mean, I could quote somebody who told me, well, the money will come from somewhere. Do we really need a capital market? And I think that's, in the end, the argument is not really that we won't have the money. I think the main argument in favor of capital markets is that if we don't have a capital market, a single capital market, the national ones will disappear. And
thank you very much, Lorenzo.
They will disappear. Yes. Okay. I stop here.
I'm gonna let Tanya respond because we'd like to hear more from you before you have to leave early.
Thank you very much. And it sent me to 5 years ago when we were discussing with Lorenzo in another forum on the CMU, because Lorenzo participated in the CMU high level forum. Maybe first with respect to the comments made by Nicola. So Nicola, you made 2 points. You know, why do we need to focus on insolvency, tax, all those complicated matters? Why don't we just focus on financial key where we actually have competence? And by the way, we do have competence on insolvency, some competence on tax, and some competence on pensions. It's not that we're without competence. The answer to your point is, of course, we could have just focused on financial key, but I think it would not be enough. The problem is that a lot of incentives, and I think Lorenzo mentioned incentives, I think Marco mentioned incentives, some other speakers mentioned incentives, are stemming from things that are not purely or uniquely driven by financial laws or supervision for that matter. Tax is a very potent driver. It's driver of investment, it's driver of operational activity. If you do not ensure that tax works in a way that doesn't distort the single market, you will still have distortions. You can solve lots of issues, but you will still have distortions. Same goes for insolvency laws. If you don't ensure same protections when it comes to bankrupt entities, investors will continue going to countries where they get better protections. Once again, has nothing to do with the potential of the companies that they're investing in, but the quality of legislation and protection that creditors are getting in those member states. So you can always, of course, tweak the the rules on a margin, but if you don't tackle also fundamental underpinnings for drivers, for incentives, for investment, you're not going to create a single market. So supervision, yes, of course, that's important. I think everyone in the room agrees, and I think I've said it as well. Obviously, this is important, but it cannot be just supervision. We have to think, holistically, and we need to address all obstacles because we will solve one, but we will not solve others. I think you also said supervision is going to be easy, or did I misunderstand? It's not going to be easy.
I think, Tanya, don't quote me because you seem to misquote me.
Okay, I didn't want to. Apologies if I misquoted you. I did not want to misquote you. But to me, supervision is going to be even more difficult than insolvency. And I'm now sitting in the room negotiating insolvency with justice ministers, and it's complicated. Negotiating supervision is going to be even more complicated. Lorenzo mentioned we need to get the right losers and the right benefiters clear and out and explain who stands to benefit and who stands to lose. Obviously, we know who stands to lose and who stands to benefit. But ultimately, I think it's about the EU interest. It's about the single market interest that we need to think about. Individually thinking about this member state may lose on this aspect, or that member state or that industry player can lose on that aspect, I think was not going to get us far. We will have a long list of losers and benefiters, but can we get everyone in the short term to benefit? No, we cannot. Yes, it will not be a zero-sum game in the first place. There will be somebody who will be negatively affected, somebody who will be positively affected. But ultimately, if overall the EU as a whole stands to benefit, then we should do it. And this is the underpinning rationale for us. We need, without single supervision, without coherent supervision, integrated supervision, this is my personal view, once again, I don't think we will get far. Now, Lorenzo, to your point, and this is maybe my last remark, those, I think you said, and I hope I don't misquote you, like I did with Nicolau, you said that most of those who are opposing supervision, centralized supervision, are non-Europeans. Actually, my experience is that a lot of non-Europeans are calling for centralized supervision because they are confronted with a situation whereby they have to, even if they have a choice in a way to choose the supervisor, they still operate in a number of member states. And often they have to adjust to a number of national competent authorities. They would very much prefer in many instances, but of course, I'm not speaking for all of them, but at least the ones that we've spoken to, they are actually quite vigorous supporters of centralized supervision because it offers a single entry point for them. And they actually would very much welcome this. Now, maybe the stakes are not the same for all non-European providers, but at least for the ones we've spoken to, there seems to be willingness to take this route. I think the opposition precisely comes from vested national interests, where you actually have a lot of industries, a lot of national interest, depending on where supervision is. And this is the problem that we should overcome. How to overcome it? I think we need to engage with member states. We need to engage with supervisors. We need to. I think this is where I think your a bit suggestion is going a bit in the direction. We need, you said, get the losers and the benefiters clear. I think we need to speak to those potential losers or potential benefiters and have an exchange with them and maybe try to understand, as you say. I think we do understand, but also understand with them how we can mitigate certain features. But of course, this should not be to the detriment of the common objective that supervision needs to be consistent. And this is the essence and the biggest upside of centralized supervision. I stop there. Thank you.
Thank you very much. I see a few people in the room that want to respond. I will throw open the floor for questions in a moment, but I know that Lorenzo has to leave us in a few minutes. So I did just want to ask you a question first. You make an interesting point about the winners and the losers of what happens when we're advancing the CMU agenda. And I think this also reflects Tanya's point about if we are going to make progress in the EU as a whole, maybe there need to be some compromises and maybe those winners and losers need to put their differences aside. Macron was interviewed yesterday and made some interesting comments about Société Générale in particular. He said that in the interest of greater moving forward on the banking union, he wouldn't necessarily oppose Société Générale being sold to Banco Santander. As someone who's very interested in the winners and losers here, and from Société Générale's perspective, I don't know if you have any thoughts on those comments.
No, I don't think this is a fair question, by the way. I don't think he said that, actually. The question was one, and he answered differently. But,
I mean, please elaborate,
no,
go ahead.
I don't think that's fair, frankly. I don't think that's fair.
Lorenzo is right. That's not what he said.
Exactly. So
please elaborate.
Don't twist, I mean, don't use your position as chair of this panel to try to extract from me anything from this, and it's not what he said. But I just want to invite Tanya to remember our high-level group. And there were 6 non-European institutions and 2 European infrastructure. And these were the strongest opponents to single regulation and single supervision. So, and the point I wanted to make at the end of my intervention is that the real argument for capital market union is that what national authorities are defending is something that is shrinking. And it would be useful to do some analysis on this. I mean, if you look at the markets, the stock market, whatever markets you have in the 27 countries, they are largely shrinking with a few exceptions. And large companies, and you had the case of Total, who explicitly said that they are thinking about moving to Wall Street. So that's the big challenge, I think, for Europe, is European companies starting to, I mean, they're already doing it now, but some really important and systemic companies moving to the other side of the Atlantic. And I think that, by the way, was also a question which was asked to President Macron. And you can see what he said, that he was a bit concerned. And I think if a few companies in the 27 countries were more explicit, and if the Commission was showing this, by the way, that would be a very strong argument for the heads of states, especially in view of the next elections, by the way. So I would stop here. So sorry if I was a bit direct, but I don't think that...
No, that's no problem at all. And I know that you have to leave us soon, but just for the avoidance of doubt, I do have the quote here from Macron's interview. And when he was asked about Société Générale being bought by Santander, I agree that it's somewhat ambiguous, but he said, it's part of the market. Dealing as Europeans means that you need consolidation.
Yes,
So clearly those words are open to interpretation.
Well,
Either way, I'll thank you for your intervention, Lorenzo. And now I'm going to switch back to the topic of central supervision and go to Nicolas. Is this possible? Is it going to happen? And if not, why not?
So I'm getting old, and I remember the debates before banking union, and I remember how affirmatively most market participants, most authorities, most experts even said that centralization of European prudential banking supervision was just impossible. It was not even worth discussing. Now we have a very, of course it happened, it works. Now we have a very different situation because we have those proofs of concept. We have European banking supervision. Very importantly, even so it's not mentioned often enough, we have AML supervisory integration because the legislation to establish AMLA, the AML authority in Frankfurt, is now finalized. I think it's even published or will be in a few days. And also, frankly, we have ESMA supervision of very limited market segments. By the way, I need to disclose here that not only do I work for the Peterson Institute, but I'm also a longstanding independent non-executive director of the trade repository of DTCC, which is supervised by ESMA in its European jurisdiction. I don't think that creates a conflict, but it's a due disclosure. And therefore, we know that it can work. We know that the notion of supranational European supervision is completely feasible, and it can even be very effective, which is the experience we can discuss about ESMA. AML, we don't have it yet, but that's the experience with European banking supervision. So that's at the ECB, it's not on the basis of Article 114, but essentially it is the proof of concept that was needed for a realistic discussion about, more about how to do it than about is it possible to do it, because we know that the answer to the question of possibility is yes. Now to Tanya about difficulty, you are in the room, I'm not in the room, so you have that advantage over me, but I've spent a lot of time observing these things. And again, I repeat the conclusion to which I've come, which is not from a legal perspective, from a political perspective. The EU doesn't have a mandate on taxation, doesn't have a mandate on insolvency the way it has a mandate on supervision. I repeat that because I think I can elaborate, I won't for lack of time, but that's the core of the issue. So this is the area. Now, I'm certainly not saying you shouldn't think about insolvency law, taxation, all these things, pensions, housing finance, which the Commission maybe doesn't speak enough about, what have you, and of course, fiscal union. I'm just making a judgment on what is feasible at this point and what is not under the present political circumstances. Now, I hope we will have to come back to issues about how to do it specifically, and especially how to re-engineer, re-architecture ESMA in order to make it both acceptable and effective as a European supervisor. Because I think there are many issues here, and it's not enough to just say, okay, let's move all the authority to ESMA. ESMA, as it's currently constructed, cannot do that, and probably cannot do it well, even with a lot more money. So let me stop here because, again, make it conversational, but I hope we'll come back to this question of, how.
Yes, I'm going to open the floor actually in case anybody wants to weigh in. And just as a reminder on some of the ideas that have been thrown around in terms of what could happen for ESMA in the future. We've seen proposals that ESMA's governance be reformed. We've seen proposals that the mandate of the organization is expanded to cover the biggest or the most cross-border capital markets actors. We've seen, as Lagarde said, a single rulebook and a single supervisor, a European SEC. I mean, whether that's ESMA or not, the idea is there. So just with those other ideas, we've also heard calls for ESMA to have competitiveness included in its mandate, and also for a supervisory model that's opt-in for the largest players. They can decide who's supervising them. So with those ideas in mind, does anyone here want to weigh in on the issue of centralized supervision? Yes, please.
Yeah. Jonathan Zeitlin here. Hi, Nicola. So, I mean, I think the exchange between Nicola and Tatiana is really a very interesting one because, I mean, on the one hand, you have a very expansive conception from the Commission of all the different things that would need to be reformed to make capital market union work. Politically, I think there are good reasons to think that that will be very difficult to harmonize. It will take a long time. And then there's the question of, is it sufficient to focus on supervisory reforming ESMA? And so my question, which is first of all a question for Nicola. I mean, let's suppose that we take something like the model of the single supervisory mechanism that was, we heard, suggested in a way by the Letta report. Having studied the single supervisory mechanism, I think it works very well for prudential supervision, but it has not led to increased integration of the Eurozone banking market. And we can discuss why that is. There are certainly a range of different kinds of issues. So my question would be, why should we think that changing the governance of ESMA, even to make it more like the single supervisory mechanism, which would be a big reform, would lead to a more effective integration of European capital markets and achieve the aims that we started out with the discussion. So I would be curious to hear how you kind of square the circle, and I'll put it both to Nicola and to Tatiana.
Yeah, Nicola, go ahead. So we're talking about ESMA's mandate, and I'd also like to throw in another idea here, which is something I've heard in sort of diplomatic circles in Brussels, which is that it's essentially a trade-off, that you need to reform ESMA's governance if you're going to give it extra powers, because at the moment the governance model isn't working, and it shouldn't be trusted with that level of responsibility when the board is dominated by national supervisors and it doesn't really have the independence that it should. I mean, that's something that was raised in the Letta report. I don't think it's a new idea. So just throwing that in your response on ESMA's mandate.
Thank you so much. And by the way, sorry if my image shakes a little bit from time to time. I have faulty settings here, so when I take notes, the camera shakes. Apologies for that. On your last point, Catherine, I think Tatiana actually answered it. She said the current governance of ESMA is flawed, and I agree. It's not at all a comment on the individuals. They are great civil servants at all levels, but it's really about the governance and what you mentioned. So to me, it is indeed a stark reality that giving extra powers to ESMA without reforming it first would probably have detrimental, not beneficial impact on capital markets union. And I would advise strongly against doing that. I think you can either imagine an integrated package in which there is simultaneous governance reform, not only governance, by the way, I will come back to this, governance, funding, and organizational reform, and expansion of the mandates, but not expansion of the or sequential. You reform ESMA first, and then you expand its mandate. My preference, for a number of reasons related to funding, is the former, not the latter, but I think both are viable. What would not be a good idea would be to expand the authority of ESMA without governance reform. I think that's a point I would make quite strongly, and again, insisting that this is not a criticism of any of the individuals involved, both in the past and in the present. Now to Jonathan's question, I think the answer here is about crisis management and resolution. So I'm sorry, because this may be a bit complicated, so it will take me maybe at least 1 or 2 minutes to explain, but this is very important. So banking union, as we know, is incomplete because the non-supervisory piece is incomplete. So in my assessment, European banking supervision is actually complete. I don't think you need more. I mean, maybe in the future it will be reformed, maybe something will be more centralized, maybe some things will be decentralized from what they are now. At the current juncture, I don't see a strong case for changing anything to the SSM regulation, which is a legal framework. And I would even say to the SSM framework regulation, which is the implementing text that has been decided by the ECB. I think the system works. It doesn't require further reform, at least for the first foreseeable future. That's not all of banking union, however, because banking union is not just a crisis prevention mechanism, by which I mean prudential supervision. It's also a crisis management and resolution mechanism. And here I'm using very usual IMF categories about the banking policy framework. And as we all know, the bank crisis management and resolution framework is a halfway house. I'm certainly of the opinion that the SRB is better than nothing, but it's not the full game. And that's why we have the discussion about crisis management and deposit insurance, about European deposit insurance, for which we should no longer use the acronym EDIS, because EDIS is now the European Defense Industrial Strategy. That's what Breton has taken the acronym real estate, if you will. And also about, I know this is controversial, but sovereign exposures and forced diversification of sovereign exposures, because otherwise, in my view, it's impossible to get the crisis management bit right. So what's the crisis management bit? It's actually simple. Forget even about all the acronyms. It's about the public safety net for the banking sector, because the banking sector needs a public safety net. And as long as this safety net has not been brought fully, I insist on fully, to the European level, there will be incentives and possibilities for the member states to ring fence. And this is exactly what the answer to Jonathan's question. Integrated supervision was not enough to prevent the member state actions on ring fencing, because the crisis management and resolution framework is not integrated. And actually, when you look closely, the member states, not thinking of any particular one, including Belgium, the member states who ring fence do that not under a supervisory mandate, but under a safety net mandate, under a crisis management and or deposit insurance mandate. So that's the answer to your question. Now, I want to address a question that I thought you would ask me, but you didn't, which is about the SSM supervisory model. You mentioned joint supervisory teams. Capital Markets Union, as has been mentioned rightly by Tanya, there are many things on which we agree, Tanya, even so that's not everything. Capital Markets Union is much more complicated than Banking Union in a way, because in Banking Union, you're only talking about the banking license, and that's kind of one-size-fits-all instrument. Even so, of course, we do it differently for significant and less significant institutions. Whereas in Capital Markets Union, you're talking about dozens of different mandates on different markets and different market participants. And that makes it much more complicated. So for significant institutions, the SSM framework regulation, it wasn't into SSM regulation, but the SSM framework regulation has successfully defined the joint supervisory teams as the right model. And I think that worked very well, Jonathan, as your research, more than perhaps any other, has documented. But that doesn't work, that may work for some of the mandates that we're talking about in capital markets land, but not for all of them. And to take an obvious example, even so that's not informed by my experience with trade repositories, you should think of market segments that ESMA already supervises. Let's take rating agencies. There is no case, in my view, to renationalize the supervision of those market segments. There is no case to move from the current situation of exclusive ESMA supervision of rating agency to something that would resemble joint supervisory teams. So one of the complexities of the ESMA re-engineering, ESMA empowerment discussion is that ESMA 2.0, the future ESMAs that would be fit for Capital Markets Union, would need to operate different supervisory models, some looking like JST, some exclusive like with rating agencies, some perhaps different, depending on the specific mandate. And that's an element of great complexity, but I think it's achievable. It just has to be recognized as one of the difficulties. Thank you.
Okay, who wants to come in there? Really, on the extremely political issue of centralized supervision, we don't have anybody that we can throw the floor open to. Okay.
Can I
Nicola, I'm not letting you talk more. No, we're going to move on. Okay, we have covered single supervision, but I want to talk a little bit about national differences, because as we've seen with the April European Council meeting, it was essentially national differences which stopped single supervision from being in the summit conclusions. We've also, I mean, there's been literature which has said for a single supervisor in the future for non-banks, you could use a model that's based on the AMLA, the Anti-Money Laundering Authority that has just had its seat decided. And there I would come back to another point, which is that many countries, more than 10 countries, bid to host the authority, and it ended up being in Frankfurt. So I think we can see certainly a certain negotiating weight that larger countries might have in this discussion. So anybody want to come in on how we square the circle of conflicting national interests when it comes to setting up a potential single supervisor? Nobody wants to answer my very elegant question. Come on, Nicolas. I feel like this is more of an interview at this point, but I'll let you wait.
I have a completely unfair situation here because Lorenzo left, Stefano left, so I don't know what happened. But I claim no responsibility.
You're my panelist, yes.
I'm just taking advantage of the situation in a completely inappropriate way. Okay, so actually you asked the question, right? How do you square the circle of the politics, the national politics, including the politics of location? I don't think all of it is about the politics of location. I think, location matters. And one fact on the ground is that ESMA is in Paris. So any talk about reinforcing ESMA sounds like, favoring France. And that's very much the view of the French government, which is kind of, fit and proper. But I have a different view because I think the circle to be squared, as you rightly said, Catherine, implies that not everything should be accrued to ESMA in a winner-takes-all situation. And to that, the French reply, that's unfair because the Germans have got everything plus more because the ECB is in Frankfurt and now they even get AMLA and they also have EIOPA waiting in the wings. That's fair. But I think, life is unfair. So to me, there are creative solutions that can not eliminate but mitigate the location concerns. And I think actually the right way to do this is not to create another agency that would be separate from ESMA in a different place, but is to invent a new model for a restructured ESMA where the headquarters would remain in Paris, but the activity would be distributed geographically. And actually, the reason why that makes sense is that precisely in banking, you have this supervisory model with the joint supervisory teams, which really integrate in a very elegant way the ECB with the national authorities. So the national authorities keep a role. As I mentioned, in capital markets, there are a bunch of mandates out there in which I think it wouldn't be reasonable to keep a role for the national authorities. I mentioned credit rating agencies as one of those mandates where the decision has already been taken to not give a role to the national authorities. Actually, the reason why this decision could be taken is that they didn't have a role, and therefore the mandate was introduced out of the blue on a sector which was not supervised or regulated before, so that made it easier. But I think it points to the way to go for a number of those market segments where really there is no case, unlike in banking, where there is this retail element, language and all that. In capital markets union, for many of those segments, you have wholesale players where everybody speaks English. There is no matter of local culture. So the case for involving the local guys is really non-existent, other than inertia and politics. So you see where I'm going here. It's possible to organize ESMA in the future, not just with the Paris office, but with offices in other financial centers. And with the division of labor. So you could imagine that, I don't know, say, the Luxembourg office has a role, has some of the core teams dealing with asset management, and is also there to provide connectivity with the market participants in Luxembourg. The same in Frankfurt, the same in Amsterdam, the same in Madrid, Milan, Dublin, you name it. Maybe one office per member state if you need that, or maybe even several if you want to have Frankfurt and Berlin and Milan and Rome. I think the expense is trivial. Of course, the calibration has to be discussed compared to the benefit in terms of unlocking the current negotiation deadlock. And I think this would not be just a dirty compromise to get the votes of the member states, which would get something in exchange of their abandonment of supervisory sovereignty, but it would actually if done well, make ESMA better, because I would argue that at this point, ESMA 100% in Paris is too far away from some of the market realities that it has to be mindful of. One last word, in terms of winners and losers. What does that mean? The national authorities are losers in any case. They should get over it. They're civil servants. They should serve the public. So they don't have reasons to complain. And we've seen that happening in previous episodes, of course, with monetary union and also with banking supervision. What is important is not that no national authority loses, because if that's your condition, nothing happens, is that no country loses. And that's why it's so important that the discussion is being elevated from the level of finance ministers, which tend to side with the national supervisory authorities, to heads and state of government who don't really care, frankly, about their national supervisory authorities, as long as no essential national interest is at stake. And I think this makes a decision to do something actually more possible. And that's exactly why they're doing it. The likes of Scholz and Macron are saying, we had the discussion basically giving a veto to finance ministers and national authorities that I haven't even ever heard of. That didn't work. Now we have to look at it more holistically, because we see the big picture that Tanya has given us and that Marco has given us before today. So I think, if it becomes Chefsache, experience suggests that the chances of compromise are actually greater than if you leave it to the usuals.
Okay, thank you. Any final thoughts from anyone in the room on the issue of central supervision? Torsten, please.
I have two questions. One, actually, first, what Nicolas just kind of laid out, which I find a fascinating idea, Nicolas. Now, one concern I would have, I mean, you let asset management supervised by the Luxembourg office, and so basically each office gets to supervise the local guys, so local segment.
That's not what I said.
They didn't say that. Okay, well, if you had said this, let's
take it. Let's take a better example than that.
No, but so what I'm saying is, would you be afraid?
Let's take a better example, which is critical financial infrastructure. So let's say Frankfurt, that's my example, gets critical financial infrastructure. It does have the lead in supervising LCH-SA, Euroclear, and also Eurex Clearing and Clearstream.
Okay, because the issue I would have with that, and it might work still, but that there will be local capture. Basically, the guys who are, if you are in the same place as the institution that are being supervised, then you get back to the kind of little bit what we had with national supervisors in the banking system, that these people, basically the supervisor, gets to a certain extent captured by the institution that they actually supervise. And then, of course, you also have a rotating door. So that's would be my concern on that. But other than that, I actually find this idea quite intriguing. Actually, I have a broader question, or well, not a broader question, a different question. And I wish Lorenzo would still be here. But so we've talked a lot about losers. I think, Tanya, you mentioned one winner, which actually non-EU providers might also, some of the non-EU players might also be winners. But who else in the EU would actually be a winner? I mean, we know the general public would be a winner, the retail investors, but of course we know also they don't have typically a voice, or at least they don't have a lobbying group. I mean, I haven't seen any party, the party of the retail investors in the European election. So is there any like a winner that can be identified and that can be used to kind of push the process forward? Number one. Number two, can there be quick wins? Can there be quick wins that can create these kind of winners, which then could basically lead to further kind of push for reforms? Thanks.
Okay, I'm going to let Marco weigh in.
Just to complement this and to broaden it even more, maybe. So maybe Marco, Lucia, Karel, Tanya can come in. Now, I think if we look back to the past, think about political triggers. Often the political trigger comes out of an outright acute crisis. We have seen that. In a number of other cases, more limited, admittedly, it's more in a positive way. So you get something and you get the bandwagon going on a positive objective. So this is it seems to me that capital markets union difficult to rely on an acute crisis. So this is one. So we had to put the deposit message out there. Second, my experience in Brussels, Tanya can confirm or not, and maybe Thomas even more, given his broader experience. I think it's sometimes much more difficult to tackle a multiplicity of cohesive small interests, vested interests, rather than a big one. And this is one of the problems with Capital Markets Union, the way we have discussed between first and second panel. So now, what is the historical precedent that could be helpful for moving things forward? Now, maybe one big historical precedent could be the white paper with launching the single market of 1985. Delors. What you had there, okay, first of all, why did it work at the time? Okay, first of all, you had you put out a good story, a good narrative, and with the Cecchini report, cost on non-Europe, etc., you had also the benefits outlined there. We had the 1992 effect. Okay, we benefit a lot from the counter supply shock, also of the fall in the oil prices, but it propelled a bit so this is one thing. Second, we had a political champion. Okay, UK, and to go back to what Lorenzo said, Commissioner Lord Cockfield, it was. Third one, I think there is, and here you have seen, we have said different positions of member states, but an element of constructive ambiguity is not bad in this. I mean, for the single market, there was, behind the scenes, there were two views. One was indeed Thatcher, UK, liberalize everything. In the French, they had the idea of a bit of a fortress Europe. So we liberalize inside, but we use this as a platform for the future. So is this a precedent, according to you, that is relevant, and could it help to get the political dynamics going?
Thank you. And I know Giancarlo, you had a question. Use my mic.
Yeah, I was just a curiosity to close the second panel. Marco was drafting some ideas about the complementarity of capital market union, banking union. So I wonder whether, in a sense of feasibility, there is any step where that may become a reality. It comes very well into this idea of finding the champion, finding the conditions. Is there anything that could be sort of brought together between these two processes?
Thank you. I'll go to Marco, and then I'll go to Nicola to close.
I mean, in terms of interests that are being served, that are going to be served by the Capital Market Union, as I tried to point out at the beginning, I think we have the most acute potential threats to the survival of Europe as we know it currently ongoing, and the Capital Market Union could be sold, should be sold to the general public as one of the essential tools to answers to things that people care a lot about. People care a lot about climate. People care a lot about not having Russian tanks in the streets. So I think these are very important issues, and I think they would, in my view, potentially be used to coalesce the sufficient consensus, political consensus around these objectives, provided our politicians perceive the urgency of these objectives. This is at the kind of macro level. At the micro level, there is a set of actors which are quite powerful and which could benefit from the capital market union together with the banking union. That's why the complementarity is important. And it is large investment banks or banks that have investment banking capabilities in Europe, with which could expand greatly their cross-border operations and would be to some extent beneficiaries of the capital market union. So it is not as if, here there are only losers. Of course, there are losers and gainers. Some of the gainers could be quite powerful potentially. So I think that on both of these accounts, there is a potential political basis, both at the macro and micro level, so to speak, to push this agenda.
Thank you. Nicola.
Sorry, one final point. Yeah. Very small point. An historical precedent. A great historical precedent was quoted by Christine Lagarde in a beautiful speech that she gave, and it is American railways. When she asks why America developed its capital market union, so to speak, and by, to some extent, curtailing banks and expanding capital markets, that was done essentially to be able to fund the capital requirements of the creation of the railway system in the United States. It's a beautiful speech. You should look it up. And that's, I think, the best historical precedent to the capital market union in Europe today.
Okay, Nicola, go ahead.
So I got 4 questions, 2 from Torsten, 1 from Marco, 1 from Giancarlo. Let me start with Giancarlo, who asked about capital markets union and banking union. And here I will speak.
And I'll just remind us that we have 1 to 2 minutes left in this agenda.
So I'll try 1 minute per question, so I won't be too much overboard. Capital markets union and banking union. This is I will speak purely tactically here. And the tactical situation, as I see it here, without elaborating for lack of time, is there is momentum in capital markets union to do something simple and concentrated on supervisory integration. And in a way, it's a bit like what Tanya said, the Maastricht Treaty, you have the euro, do it, and we don't care about the details. Here, I think we can have something similar. Get the capital market supervision integrated, do it, we don't care about the details. And I think that would be the plausible decision to be made shortly. And I don't see anything so close to decision in banking, in the space of completing the banking union. So as much as I am a passionate advocate of completing the banking union, I would say the sequence probably has to go that way, focus on capital markets union first. Second question, Marco's question about crisis and precedent and, a prompt to action. So there is a precedent, which I think would be my preferred precedent, of this kind of reform not being done under the pressure of an immediate crisis. But I do agree with what others have said, which is the immediate crisis is there. It's the war in Ukraine. It's a geopolitical escalation, and that concentrates minds. And I think it's precisely because of the war in Ukraine and the prospect of Trump being elected and the problems with China and so on and so forth and Gaza, that's really the reason why Scholz and Macron spend time on capital markets union now that they have never spent before. Now, having said that, I think there's a precedent without an acute crisis, a crisis like in 2012, where things had to be done in a day or a week. And that's European Monetary Union itself. If you look at the story of the Delors Committee and the Maastricht Treaty, it was in an environment where there was a sense of urgency, there was a sense of impending crisis. Actually, the crisis happened a year after the Maastricht, but there was no acute crisis at the point of decision, and I think that should give us hope. Finally, on Torsten's questions. Local capture, I would say it's easy. Look at ESMA now. Is it captured by Parisian interests? Maybe to a certain extent, but we can live with it. And if everything remains concentrated in ESMA, you have Parisian capture if you think that's a thing. Look at the ECB now. Is it captured by German banks? I would say no. You could make a case, and maybe this is a sacrilege to say that there was a time when maybe ECB supervision was slightly captured, not too much, thankfully, by the Italian banking sector. I don't think that's the case now. And by the way, I don't mean the last 5 years about that. But I don't think, I think if it's well engineered and if there is strong European legislation and a mandate, you can avoid capture. And frankly, nobody says that DG Comp is captured by Belgian interests. So I think these issues are matters of good governance. Finally, the winners and absence thereof as engines for reforms. Here I would respectfully disagree with Marco. The big investment banks, they're very conservative. Look at banking union. None of the big European banks is an advocate for completing the banking union, even so it's obviously in their interest. And I think that has been a lesson of the last 5 to 10 years, that it's not enough to have the interest, but actually they don't want to get into a difficult relationship with their existing supervisors along the way. And that makes them enormously conservative. So I think the same is true for the big investment banks. They won't lobby for supervisory integration, frankly, because they don't want to get into an awkward situation with their existing national supervisors. We can discuss whether it's that good or bad or legitimate or scandalous. I think it's a fact. So Lucia is right. This is a typical Menker-Olson collective action political economy thing, where the winners are distributed, the losers are concentrated, and therefore you have difficulty in taking action. But again, if it becomes Chefsache, you can make it work. And there are plenty of middle-sized players which have a strong interest on this. They don't constitute a powerful lobby, but they can be cheerleaders.
Thank you very much, Nicolas. I think we had one last intervention over here on this side of the room. Carol, you wanted to speak?
Very quickly on the winners, the precedents, and on what we could do. First of all, I mean, precedents is network industries. Look at what happened in telecoms, what happened in transport industry, what happened, for example, in aviation industry. We can enforce, we can go against monopolies, and that's certainly the case for CSDs, as I mentioned. And if we do it, who will be the winners? I think the cost overall will go down. Let's say it will be an overall, the European economy will benefit. But also, it's like we see in many of these industries, the investments they have to make today in IT, for example, at the moment, they need to move to T+1. They cannot, because they are afraid to lose basically half of the liquidity which they have today. And the other one, as I mentioned to Tatiana, is enforcement. If we were to do enforcement, but Tatiana was saying, look, they can only do 3 cases of peer pressure a year. So then you know right away what the problem is. And if you were to act rapidly, let's say, you will see the effects.
Well, thank you so much to all of our panelists. And okay, Nicolas, we thought it was over. It is. I'm sorry, Nicolas. I think we're gonna have to come back to it. You're appearing at a conference here in a few days. We can talk about it then. I'm sorry. I'm gonna have to cut you off as we're very much at the end of our program, and hand it over to Giancarlo for his closing remarks. But after thanking our panelists. Oh, you want? No, please. Okay. After thanking our panelists. Thank you to our panelists.
I don't want to take any time. I wanted to also thank the panelists, but we already done it. So I'm specializing in closing these events. I would like to make 3 remarks. So I'm just hearing everything and trying to bring together with a personal perspective. One thing is that thinking of the Capital Market Union as risk-sharing and growth, perhaps is now risk-sharing growth and existential threats. So that would be where the point is not that the first 2 are not important, but the third one, it becomes the selling point. And perhaps if it really the existential threat, the Capital Market Union can be selective and innovative. So at the end of the day, you really want, big, large investment banks. You want what I call the kind of public sector kind of venture capitalist able to come and work with public sector, a big program. So this is for the existential threat. I hear Billy Smaggin say that there is kind of lack of trust that the Capital Market Union will go into investment. This is something that perhaps should be thought. On the other hand, if you really want to finance, for example, defense is notoriously the petri dish of corruption. So a European process on the financing and the control would not be a bad idea for people interested in having a good defense and a minimized tax burden. On the growth, though, I would like to ask you for the next panel, next time. Things are changing, right? So the number of listed firms in the US is falling dramatically over time. I know from one of your papers that the leverage of firms is falling dramatically across firms, across industry sectors, across countries, that these firms prefer to be full of cash, no? And also the public good we are going to finance is not only a bridge that may go wrong because the cost goes up, it's also kind of project that may not go well. So all this means that the capital market union that we would like to have is not a capital market union that we may know of the type we knew in the past. There's something market union that need to respond to these questions. I don't know how to do it, but clearly there is what we want to bring the saving to finance is an interesting question. The second point I understand from Tatiana and other people is that perhaps what is the unifying way to think about the problem of the capital market union is the fact that we are living financial repression by stealth. So at the end of the day, it's not the single lobby that create a problem. It's the fact that sovereigns are very interested in keeping things as they are or keeping markets segmented. Once you see this is typical monopolistic. You know, the big monopoly always have millions of little guys who complain to keep things as they are. So if they want to stop the lobby, the government can stop the lobby. The fact they don't stop means that they have an interest in keeping things as they are. So if this is the problem, then the problem is how do you go around it? How we can sort of address this issue of the financial repression by stealth that comes together with a high level of debt at not only sovereign, but also contingent private debt. Last thing I want to quote is the broken record, which is a so this talk about the capital market union is kind of a broken record. We always say the same thing. The issue is that this is a broken single market. We have more than a segmented single market. We have a system where now we are sitting on a state that we consider reasonably stable. We hope that will be at least for some time stable, but it's not a single market. You cross the road in Austria and the same industry who produces the same shoes with the same market pays 2-3% more on their borrowing cost just because it's across the street. So this is clearly something that you know, it is sort of something that one question I have for you also, whether there is a market solution that may go around this thing. So whether the capital market union may be happening without us knowing in ways that at least for certain category of firms, they get out of this situation which you can go on vacation where you want, you pay with the same. You still have problem with pension portability, but you can go to work. But if you want to invest in Italy, you pay twice the dividend taxation because the Italian government has decided that the Lordo Frontiera. So like this is like an example from the saving, but the striking example is that there is no capital market union on the financing side. So I just wonder whether there is any sign that, you know, I don't, that the markets are already providing a solution to this, which is not obvious because since 2009, when I started to work with this with my students at the IMF, it was a clear, enormous correlation of private, corporate, non-corporate, and sovereign spread. There was a paper with Andre Meyer in 2009, and I remember Trichet complaining that I know very well, Professor Corsetti, this. He didn't know actually. It was something that, because at that point, it was really the impression there was an issue of sovereign risk, not an issue of national spreads, no? that goes across. So I should stop here and thank again all the panelists and invite you maybe sometime from now to get the answer to this question. Thank you.
Can I? Yes. Okay. Logistics on the next step before maybe we say something at the very end. But okay, the dinner is for invitation only, but we invite all of you around the table if you like to join. So also the students, if you don't have burning commitments tonight, you can join us both for the cocktail and for the dinner. And we are going to have Thomas, who is going to address the
Marco, sorry to
the
interrupt.
dinner with some you know,
I'll
personal
speak,
experience.
I will not speak longer than 2 hours.
No, okay.
Sorry to interrupt, Marco. If you hear me, I guess there is no possibility of joining remotely, correct?
Give it a try. We will pass wine to the whatever.
I'll send you some notes, Nicolas.
Yes, thank you so much. No, sorry, that was a joke. So the answer is no, correct?
No.
Thank you.